Right, so we're still looking at this whole idea of the macro economy. Maybe just to recap, chapter 4 is looking at that concept. Do you remember what the macro economy involves? Like, what is the focus?
So macro economy was like the economy as a whole, what looks at it's like the big
picture. Yeah. Perfect. Then we spoke about aggregate demand and we spoke about aggregate supply. What does the word aggregate refer to?
Aggregate, the total.
Exactly, very good. Okay, so now you know we're dealing with totals here. Total demand, total supply. Here we've got the topic balance of payments. So now if we're looking at the balance of payments, do you agree we're looking at spending because businesses will have demand and supply? And balance of payments here is a record of a country's economic transactions with the rest of the world over a year. So balance of payments is looking at the entire country. Entire country spending, and this represents the amount of economic transactions with the rest of the world. So the balance of payments is basically going to look at, well, how much do we buy and how much do we sell with the entire world? Okay, you would want what? More imports or more exports?
More exports.
Exactly. So as a country, the balance of payments should hopefully be swayed towards the export side of things. Because if we as a country export more goods than we import, well, it's not good if we don't, it's good if we do. Yeah. So if our exports are better than our imports, that shows we're selling more than we're buying, which is good, exactly. Okay, so a country's balance of payments is a record of all the economic transactions between residents of that country and residents of other countries. There is a standard presentation of the balance of payments account recommended by the International Monetary Fund. So just a note, IMF, International Monetary, I'll show this to you now just now, Fund, okay, Monetary Fund determines how the BOP, I'm just going to abbreviate, balance of payments, BOP, is measured. Right, so they guide the process in terms of the measurement of this balance of payments. Okay, remember, we're trying to identify how much do we import, how much do we export to get an indication of the country's situational position in the markets. Okay, because we've got a global market, maybe that's also something else. In the global markets. Right, so we're looking at how we interact with the rest of the world. Okay, let's talk about the components. So we need to expand. How many are there? There are 1, 2, 3, 4. 4 components for balance of payments. So let's write them down. Balance of payment components. This is important. What makes it up? What makes balance of payments, basically? Okay, so the first one, number 1, trading goods. Goods being bought and sold between countries. The textbook says, as the name suggests, this covers exports and imports such as cars, televisions, clothing. They look at the credit terms between countries in terms of how much they buy and sell. They also talk about a balance. A trade in goods arises when revenue is greater than export expenditure. Okay, that's worthwhile. Let's write that down. Okay, so positive BOP, balance of payments, when they said export revenue is greater than import expenditure. That's something to consider. Okay, looking at trade in goods. If you want to put examples here, let's put one or two, e.g. cars. Cars normally come from other countries that have the technology to produce them, okay, and produce a certain type of or make of vehicle. Cars, I'm just going to use the word technology. Okay, so for example, the phones, iPhone comes from America. Samsung comes from Korea, and those are the two big brands that sell those types of items. Okay, we're looking at cars. Generally, the good cars, the best cars in terms of brand, generally come from Germany. Okay, Germany is famous for really good quality cars. Okay, Audi, BMW, Mercedes-Benz, all German brands. Very, very, very good models of vehicles. Okay, and then you obviously get others as well. Okay, that's number one. 2, trade in services. And again, that speaks for itself. Just to highlight something here, they say trade in services include invisibles. Okay, that's the inverted commas, invisibles. So what do they mean by that? Shipping, tourism, banking, insurance, etc. So shipping, tourism, banking, etc. There's a lot of different services that the world could buy and sell, okay, between countries. So one country might export a lot, and they might have shipping capability. So those large container vessels that ship all the cars. Even for example, the BMW, Mercedes-Benz, Audi, if it's not produced in the country, it must have been imported. Okay, and I mean, you know how big a car is. So now, can you imagine how big those ships have to be to transport all those vehicles across the ocean? And those large container vessels is still the cheapest and easiest way of exporting large items of or large amounts of goods from one country to another. Here we're looking at the services. So how do we exchange services between countries? Right, number 3, income. That's another factor, component. Okay, and income again, pretty straightforward. Here they said, income includes the form of profits, dividends, interest earned on investments that are in foreign countries. They call that foreign earnings or investments in a specific country. For example, dividends paid on foreign shares. Okay, so income, the benefits from the foreign investments. Let's use that word. Foreign investments. Example, dividends, etc. Any payout from those countries. So as a South African country, we can invest in other places. Or other countries can invest in our country and they would receive income. And remember that's the balance of payments. That moves that buying and selling basically. And the last one, current transfers. Number 4, current transfers. Okay, what is a transfer?
Transfer of money.
Correct. So here we've got receipts in exchange for goods and services. They include government transfers such as payments to and receipts from international organizations and foreign aid. So that's transfers of money. So for example, we had, in the news, remember we spoke about Donald Trump previously? What did the US, the UK and France do recently?
The US, UK and France, I'm not sure. I don't really watch the news.
You don't, okay, that's fine. They actually bombed certain suspected chemical weapons facilities in Syria. Okay, so Syria is a country, or a city in the Middle East. Okay, country in the Middle East, and they actually bombed certain targets because apparently they used chemical weapons to attack certain places in Syria, and now chemical weapons are very bad. Chemical weapons it's like breathing. So like, let's say you've got poisonous gas, and that kills people, and it doesn't just kill people, it actually, people suffer, and that's not good. So US, UK, France, they basically did certain attacks to try destroy those suspected facilities. Okay,
we watched a movie this weekend about how they in, I think it's Afghanistan.
Okay, yeah.
Yeah, and they had it was all about the dogs that go and snuff where the
really?
are and stuff.
Wow, that's interesting.
And it's a true story, so it's on box office.
Okay, that's interesting. I haven't seen it, but it's similar to what you're talking about.
Yeah.
And it's actually like current information. They literally did those bombings like last week or the week before, so very new. And the big question mark is this the start of World War III? So you've probably done some history, right? So World War I, 1914 to 1918. World War II, 1945. So we haven't had like a massive world war for over 50 years. So they kind of say history repeats itself, and that's a funny way of repeating itself. So let's hope it doesn't, because World War III would be very, very, very bad, because nowadays you literally just press a button and you can destroy a whole country with like the nuclear weapons and things like that. So the big concern is, well, you've got America, UK and France on the one side, and on the other side with Syria, you've got Russia. Okay, now is that going to affect the economy? Definitely. So when we look at something like this, macroeconomics, world politics affects the economy. So now trade between those countries and those countries are going to be affected, because there's obviously tension between those two countries. Right? And we've mentioned politics previously in one of the other chapters. We spoke about like the political, what is the right word? The political, maybe stability, or the political, it's sort of like the issues that those countries have to deal with. So obviously you've got certain countries not liking other countries, and that creates a problem. Okay, something else we spoke about was the tariffs, the trade war, where America, so Donald Trump wants to place all these tariffs on certain imports from certain countries.
Sure. Yeah.
Yeah, why? Because he wants American companies to do well in the country. Okay, because we know buying goods from certain countries are cheaper. So now he's trying to avoid that. So he's very much pro-America, and that's kind of what's happening right now. So those are the two big things. They're talking about trade wars between countries, and they're talking about possible World War III. Okay, that's sort of like a little summary of what they're kind of talking about in the news right now. Okay. All right, so the transfers that we're talking about here is aid. Aid, donations, transfers, let's see, transfers of funds, goods. That's what we're focusing on there. Okay, and that's the form. Right, so you're probably wondering, how do we measure the balance of accounts or balance of payments? So the next part here in the textbook talks about these different accounts that you would have to consider. So same focus, but we're looking more at the measurement here. So let's delete that.
Let's start a new page.
Yeah, you can. There's still quite a bit in this chapter, so we'll need more space. Okay, so we're still looking at macroeconomy. We're looking at aggregate demand, aggregate supply, but here we're focusing on balance of payments. Components is fine, but I'm just going to put an asterisk here, or a bracket here. Specific accounts in asterisk measurements. So now how are we going to get a good view on the balance of payments? Well, the only way we're going to do that is by looking at the actual inflows and outflows. Yeah. So how much comes in, how much goes out. And there are specific accounts we need to focus on. So the first one is the current account. Again, definitions here. So I think you should write them down. There are 3.
Okay.
Here's the first one.
So what's the balance of payments component?
Yeah, it's still the same thing. So same topic, just looking at a slightly different thing, which is that in brackets, specific accounts, asterisk, the measurements. So if I want to know how much a country is importing and exporting, I'm going to be looking at these components in terms of measurements.
Yeah.
So the first one, you've got 1, 2, 3, 4. You can also look at a deficit as well, but that I see that covered separately, referring to a deficit or a surplus, okay, which we'll discuss just now. Let's first consider this, which is the current account. Okay, so no, just write on the heading so you've got that.
Okay.
Number 1, current accounts. Okay, quite easy to remember. You can also think about your accounting here. If something is current, it's looking at like now, it's like present. And if it's a current account, you're dealing with this. Within the balance of payments, a record of the trade in goods, services, investment income, and current transfers. So it's looking at 4 things. Current account covers the trade in goods, services.
Can I write that?
You can write it down. Investment income and current transfers and transfers. That's what you're looking at. That's the current accounts. Number 2, capital accounts. Maybe just to give you more context. If I'm looking at the current account, do you agree current means now, means what's happening at the moment? So if I'm looking at goods, services, investment income, and transfers, that's looking at the current situation in terms of what our country is doing with the rest of the world. Okay, so the more we import, the more we export, there's obviously going to be an impact on the current account. Okay, current account is the current situation, what's happening. Like how much are they investing? Are they taking money out of the country? Are they investing more in the country? That type of thing. Okay, it's looking more at the present moment. You'll see capital slightly different. Again, just think of the word capital and what accounting definition capital has. You can kind of relate that to this. Yeah, no worries. You're right. Just want to plug this in.
Okay.
Got it. Okay, great. So capital, again, if you want to write the definition now, that's fine. Within the balance of payments, a record of capital transfers and acquisition and deposit of non-produced non-financial assets. Okay, so this is looking at capital, which is longer term. So the first thing is covers capital transfers, acquisition and disposal, acquisition and disposal of non-produced non-financial assets. That's what they're looking at there. Okay, it seems quite odd to have an acquisition and disposal of a non-produced, non-financial asset. So something that's not produced and something that's not financial. So now, can you think of something that would fall into that category? Okay, so a financial asset could be something like a loan or an investment in terms of savings. Non-produced would be something that's not produced. So for example, chairs and furniture, cars, those are all items that are produced. We're looking at things that aren't produced. So what could fall in that category?
Just
non-produced and non-financial assets.
non-produced.
Yeah, something that's not produced or not manufactured, and something that's not financial. So not manufactured. So chairs and tables, computers. Okay, raw materials wouldn't be produced. That's correct, but it's not what we're looking at here because that's still production in a way. Okay, it's a fact of production. Any idea? Okay, a copyright.
Okay, like.
Or patents or trademarks. Alright, so it's kind of like laws, well, not really laws, intangibles, that's the right word. Copyrights, trademarks, brands, patents, etc. Those are some of the non-produced, non-financial assets. Okay. Remember, countries have certain amount of intellectual capital. Okay, so if a new country or if a country comes up with a new development or new research thing, new invention, something different, something totally out of the ordinary, those would be considered non-produced, non-financial assets. Okay, they gave you similar examples here. Copyrights, patents, trademarks. Alright, the next one, financial account, number 3. Simple, the word financial gives it away. Financial is looking at 4 parts. A, direct investment. So I'm going to write a note here. Covers financial trade. Okay, when I say financial trade, I'm looking at things that are bought and sold between countries, but financially. So in other words, A is direct investment. Okay, that's a form of trade. Portfolio investment. Right, so a portfolio is looking at a group.
Thank you.
They are the definition.
Yeah, every group of transfers or participants.
Yeah, financial assets between countries, we're in the rest of the world. It covers financial trade, inverted commas, financial goods. That's what you're looking at there. Okay, then they just give you four types.
So
right.
these are the different types of financial accounts.
Yes, okay, we're looking at different, let's say, transactions that can take place in the financial account, which is looking at the trade of financial goods, such as maybe shares, bonds, etc. So just to cover some of these topics here, the first one, direct investment. So building a factory in another country. Is that good? Yeah. Very good. Is that an import or an export?
Export.
It's actually an export, yeah, because another country is building something in our country, so it's a form of investment. Okay, there would be an inflow there. What would the inflow be? Well, capital would come from another country into this one, and they would then build something of value. Okay, a portfolio is looking at the purchase and sale of government bonds and shares that do not involve legal control over a firm. So portfolio investment would be a selection of assets not related to a firm or to firms, okay, to companies. A firm is another word for a company. Right, that's portfolio of portfolio investments. The next one, other investments. Other investments. Okay, and other is quite broad. They don't talk about too many here. They do give you an example here. They say bank loans and give intergovernmental loans.
Anthony,
Sure, no problem.
will you phone me later and let me know what you want to do?
Yeah.
We were talking about other investments. Other investments, this part covers short-term movements of financial investment, including bank loans, intergovernment loans, direct, portfolio and other investments generate investment income that appears in the income selection of the current account. Okay, so what are we looking at here? We're looking at other investments that relate to government or the financial sector. Okay, so this would be, I'm going to put a word here, unrelated financial investments separate from the above. That's what we're looking at there. So it's not the usual, it's the unusual, if that makes sense. Alright, and then D, the last one, reserve assets. Okay, you've probably heard of foreign reserves or gold reserves, or they talk about currency reserves, okay, foreign exchange reserves. Okay, so if I have a country, what does the country keep? They keep currency. Why? Because they trade with other countries. So if we buy a lot of goods from America, would it be a good idea to keep dollars? Very good idea. Why? Because the dollars will go up and down. Okay, so if I'm buying and selling a lot, so let's use an example. Let's say, okay, the whole Australian thing, because obviously you were accepted at one of the institutions there in Australia. So now let's assume you're traveling back and forth, okay, and you're obviously going to live there, perhaps and study there as well. So now, is it a good idea to hold on to some Aussie dollars?
Yeah.
It would make sense. Why? Because the Australian dollars would be dollars that you would use in that country.
Yeah.
And do you always want to convert the dollars, okay, the Australian dollars, into rands and then convert it back? No, you don't. Because what does that create? Expenses. It creates a charge. Okay, and let's assume that you are actually working as well in the country. Okay, let's say the whole family moves and the whole family is running an operation in Australia, but the same thing's happening in South Africa. So everything you earn in Australia, are you going to convert it to rands? No, because some of it will be needed in that country. You see what I'm saying? So the Reserve Bank, the government, is going to keep things like gold reserves, currency reserves. They call that foreign exchange reserves. These reserves are kept for future transactions between those other countries. Right, so if you're doing a lot of business in other countries, for example, Australia, it'll be a good idea to keep some of its currency. The only reason why is because we are going to be doing future business in that country. Right, so if we're earning Australian dollars, let's keep some of it if we're going to be transacting in Australian dollars. Okay, rather than having to take the Aussie dollars, convert it into rands, and then later on convert rands back into dollars. It creates a problem, it creates additional costs. And those are the four for a financial account. Okay, remember financial deals with all of these considerations. Okay, things related to finance. Okay, financial goods and services. Right, the last bit is looking at net errors and omissions. And this relates to balance of payments. I don't want to write this as a separate heading because it kind of relates to what we have here. It's just an extra consideration. So I'm going to shrink this a little bit and then just put a note at the bottom here, asterisks. Or NB, net errors and omissions for BOP. Balance of payments. Right, so let me ask you this. If we are going to be transacting with other countries, how easy or difficult is it to keep control of all the money that flows between the two countries?
It's difficult.
It's very, very difficult. So that's what they're talking about here. They're saying, the textbook says, the balance of payments as a whole must always balance. It needs to be matched with a corresponding debit and credit. If the country exports, these exports will be recorded and those exports will be linked to a import, okay, in terms of the balance of payments. So they said here, a deficit on the current account or the balance of payments should be matched by a surplus of equal value on the capital and current accounts. In practice, however, with so many transactions involved, it's difficult to keep an accurate record. See, there's the problem. It's very, very difficult to keep an accurate record in terms of what we've got and what they've got, in terms of the trade between countries, one country with another. So here, accuracy is a consideration. Just to add something here as well, in terms of the theory that they gave in the textbook, they said deficit, or let's do e.g. example, deficit on the current account should match with a surplus on the capital and financial accounts. This is one example that they've given in the textbook. Okay, so all this is saying is we need to match everything. We need to have a balance of payments, basically. Okay, just to use the word balance of payments. If I'm looking at errors and omission, very, very difficult for an entire country to make sure that everything is 100% accurate. Right? It can be close, but it might not always be 100%. As long as we have something that matches with something else, meaning the deficit we have on the current account should match with the surplus on the capital and financial accounts. That's something that they need to consider. And that's why they said to compensate for this, a net errors and omissions figure is created. So do you agree? It's almost like a suspense account. I don't know if you remember that from last year. What does a suspense account do? It keeps the mistakes. Okay, and then you've got to find those mistakes. Where's the debit? Where's the credit? Ooh, okay, now it matches. Same thing happens here. Okay, but on a much larger scale. We're not looking at a business. We're looking at an entire country. Okay, so net errors and emissions for GDP, for BOP, sorry, not GDP, BOP, brackets, a separate, maybe I should actually write that down here. I'm going to change this color, net emissions and commission. I'm going to use red there. I'm going to underline it, and I'm going to put a note in brackets. A separate account to check. That's kind of what you're looking at. Okay. Makes sense?
Yep.
Right, what else do we need to do? Causes. Use the deficits. Consequences. Okay, this is more theory related to what we just covered. So, separate page.
Can I see this theory to see how I'm going to lay it out?
It's only 3 sections. Looking at other considerations here for balance of payments.
Foreign exchange rates.
Yeah, the rest is new topics that we'll look at.
After that, I can maybe start in what I did at the bottom. Trade blocks.
It's a lot of theory.
It's a long chapter.
Yeah, it is quite long. Okay, well, we're almost there. Remember, 128 is the last page. Okay, so balance of payments, disequilibria. What does that mean? Exactly. Okay, equilibrium is where we have one thing meeting the other thing, and they're the same. So now we need to look at causes of a current account deficit and causes of a financial account deficit. So I'm going to put a note here. Differences to be explained. That's what we're focusing on here. We're looking at balance of payments. So the first is a current account deficit. That's the first one. Okay, so when you see the word current account deficit, what does the current account refer to?
So isn't this heading the what are we doing?
Balance of payments, disequilibria. So meaning differences. That's what I wrote down here. The differences that need to be explained. Okay, meaning they're not in balance. They're not in like sync. They're out of synchronization. And we need to check why. Okay, so do you remember what a current account covers? Current means now. So we're dealing with what? Financial or other? Other. Because financial is the financial account.
Okay.
Current is the day-to-day, the trading of goods and services. Capital, remember, was the patents and copyright and trademarks. Right, just looking at what we just looked at. So, if I'm looking at the current account, this is looking at trade in terms of goods and services. So, what would explain the differences in the current account with the other accounts? Well, the first one would be a growing economy. Right, so if we have a growing economy, are we going to import more or are we going to export more? We're going to import more, and that's why we have a current account deficit. Okay, so the deficit means we as a country need to consume more resources. We're consuming more resources because the country is growing and expanding. The example in the textbook, firms that increase their output, buying more materials, buying capital goods from abroad, import expenditure increases. There's a summary. Okay, B. Declining economic activity in the trading partners. Okay, so let's understand that. The textbook says, if the countries that buy this country's imports experience recessions or slowdowns, are we going to export more or are we going to import more? Okay, so here's the example. As a South African economy, our trading partners, okay, so let's say America, UK, Europe, those countries have a recession.
Yeah.
So there's a decline in economic activities in our trading partners' countries. Right, so in the US, they have a recession. How is that going to affect us? How?
Because now we can't import from them.
Yeah, we can't import from them as much, and we might not export as much, exactly. And what does that do? Creates a current account deficit. Does that make sense? Okay, so demand and supply affects the imports and exports with other countries. Yes, that's another reason why we have a current account deficit. The third point, and that's the last one for this one, structural problems. If something is structural, that refers to how the country is running in terms of its facilities, its capabilities, and so on. So the textbook talks about the impact, causes for the deficit. A current account deficit that lasts over the long run is more of a concern. This is because it indicates that domestic firms are not internationally competitive. That's the key. Right, so let me ask you this. If our companies cannot produce goods that the rest of the world wants, will that affect our exports? Yes. So will our exports be more or less? They'll be less. Good, because no one wants those goods. See, structural problems. So, businesses inside the country are not competitive, i.e., we're not going to export as much. So if we want to grow as a country and if we want to reduce the current account deficit, we need to make sure that our products are so competitive that everybody out there wants it, and then more people will buy it, so we will export more to those countries. Right, number 2, financial account deficit. Okay, so just to recap, the financial account deals with what type of things you've got on your page?
Direct investments.
Good.
Investments and other investments.
Yes, so now you've got all those investments, right? The direct, what is the other one? The portfolio.
Assets.
Yeah, the portfolio. So now, if you've got those financial assets, in terms of those financial accounts, what would cause a deficit?
I don't know.
People investing more or less.
Investing less.
Good. So a lack of confidence is what would affect the financial accounts. So lacking confidence, business confidence, affects the financial accounts. Right, so obviously if things are looking good, if there's lots of confidence in South Africa, right, you're not going to have a deficit, you'll probably have a surplus.
Okay.
I'm just trying to see what else we can summarize here. Okay, another thing they said here is movement of firms and funds out of the country reduces tax revenue and employment and results in a country moving into recession. So if we have businesses that are operating in South Africa and they choose to move elsewhere, is that going to affect us? Yes, a recession could be a reason why there is a financial account deficit as well. Right, so it's not a problem. A financial account deficit is not necessarily a problem, especially if there's an inflow of profits, interest, and dividends in future years. So we can live with short-term pain, as long as we get long-term gain. Just a note. Recession is generally temporary. A financial deficit in the short term is fine as long as there is a surplus in the future. Right, so sometimes you need to go through a little bit difficult times. Okay, so businesses have challenges, countries have challenges. Okay, and this is actually quite recent. So you probably know a few months ago we had lots of political uncertainty. Okay, no one wanted to invest in this country because things looked pretty bad. Okay, all the corruption, all the fraud, all the investigation. Right, and then things have actually improved quite a bit since then because the government has actually tried to clean itself up in terms of taking certain people to courts, going through the process of, on the news this week, there's been quite a lot of news about the assets of the Guptas being seized and being kept in the country, and they're investigating the fraud and corruption around their family. Okay, and that's actually what the news is talking about. So I forget which units, but some law enforcement units actually seized those assets. So those assets actually belong now to the state. Until the investigation has basically completed, then they will either get back the assets or the state will keep the assets. Okay, so that's something that's happening as well. And again, that's looking at financial account deficit. So pain in the short term, but hopefully in the future it gets better. That's how it's looking. That we've looked at. Current account deficit. Current account surplus we looked at. Okay, so that's fine. Okay, there we go. Next bit. Definition and measurement of exchange rates. That's a nice section.
There's our workbook as well in case there's sections we don't do.
Okay, let's have a look. Let's see.
This is a huge chapter. So everything is in there.
Yeah, let's double check. Okay, so balance of payments we looked at. Current account capital, financial net errors and omissions we've looked at. Current account, trading goods, services, income and current transfers we looked at. Capital account we covered. Financial account we covered. Net errors we covered. Okay, balance of payments, disequilibria we looked at.
Yeah.
They gave me an example here of the South African trade deficit, and they spoke about July. Okay, this was from previous periods. The South African trade deficit narrows, there's an example. Causes of the deficit we looked at. Causes of financial deficit we looked at. See, inflows of profit, interest, dividends in future years. Okay, must we cover foreign exchange rates? Yes, we do. That's the next bit. Okay, so yeah, it is still part of the course. After this chapter, you can actually do assignment 5. Okay. Right.
You try to catch up on all the economic assignments this weekend.
Okay, how many have you done?
I've started the first one.
Ooh, okay, you're quite behind, yeah. I mean, after all of this, you're ready to do 5. Yeah, so just try to catch up if you can this week. Okay.
They're just much more harder than the business ones.
If you struggle, let me know, then we can discuss it. Okay, because the theory is quite, let's say, abstract, because it's like big, it's like high level. It's not like simple where we can operate a business, it's easy to make decisions. Here, one decision affects this, affects that, affects this, and all of that. So it's a bit more tricky. Yeah. Okay. Oh yeah, you were going to write this here. There's it. Okay. Measurement and definition of exchange rates. New topic. Still looking at macroeconomics though. Okay, so let's try to keep it simple and let's identify what this deals with. Do you know what an exchange rate is?
No.
What would you say it is?
It's So the different currencies involved in, yeah.
Perfect. Okay, so it's an exchange. Okay, the price at which we are going to exchange one currency with another. So if I'm looking at exchanging rands to dollars, I'm going to have to pay around 12 rand per dollar. Okay, that's the current exchange rate. It's hovering around 12. If I want to convert rands to euros, okay, that's about 15. Right, so obviously different countries have different rates. What are we looking at here? We're looking at that exchange rate. Why? Because we look at the macroeconomic picture. Macroeconomic means big. Right, our country is going to be trading with other countries. So we're going to be buying and selling oil. We're going to have to look at the exchange rates. That's important. Why? It's going to affect the country's imports and exports. Okay, so you can write down the definition. Once you've got that, then I'll summarize what's in the textbook. Okay, I see there's no real calculations here. The work program doesn't talk about workings or calculations. So I don't think you're going to need the equations. They didn't even give you the equation here. They did say read pages 95 to 97. So that's on the next page. I see there is one formula here to get the exchange rates. I'm going to write down the equation. We'll see later when we do past papers, do we actually need it or not. The work program doesn't specifically show the equation for the exchange rates, but you never know. Okay, got that. Okay, here they're talking about Indian rupees and exchanging US dollars for them. We spoke about rands and dollars. It doesn't matter what currency you're dealing with. It's just looking at taking one exchange, one foreign exchange and converting it into another. That's all. Keep it simple. What the textbook then talks about is in practice. Countries that trade with other countries have different foreign exchange rates, and we then use a trade-weighted exchange rate. Because generally the prices of rands and dollars change every single minute of the day, every second of the day. Why? Lots of buying and selling. Okay, so we need to write that down. Number one, or first bullet, a trade-weighted exchange rate. Bracket. If something is trade-weighted, it means it's taking the like a percentage. Okay, so a percentage of the trade that's being exchanged as a basis to determine the exchange rate. So using a percentage to help calculate the rates. Okay, a trade-weighted exchange rate. Then you've got the second one, a real effective exchange rate. Those are the two exchange rates. Alright, and the textbook talks about this as being a real effective exchange rate takes price changes as well as exchange rate changes into account to assess changes in the competitiveness of the country's products in global markets. So the real effective exchange rate, brackets, takes other factors, or takes other global market factors, let's use that, summarizing it a bit better, global market factors when establishing the rate of exchange. That's what you're doing. Okay, so I could use an example to describe this. Right now, America, UK, and France recently bombed the suspected chemical weapons facilities. So if that's the case, we would probably expect those currencies to be affected. The supply and the demand would be affected for those countries. Right, so if we're looking at imports and exports, maybe certain countries like Russia aren't going to be importing as much goods from those countries because they don't support their actions. Right, and if that's the case, it's going to affect the exchange rate. It will either weaken or strengthen the US dollar. Here they're saying is, well, we're going to look at all those factors and we're going to come up with this real exchange rate. Does the real exchange rate have a formula? Yes, it does. It's looking at nominal exchange rate times domestic price index over foreign exchange rate. Okay, I'll write down the formula here.
Is this a different one?
No, it's just the formula for this. I'll highlight this. This goes with this. Nominal exchange rates. Exchange rate, can I abbreviate? I'm not going to fit it in.
Yeah.
Okay, ER, exchange rate times domestic price index divided by foreign exchange rates. I'm just going to put a bracket there, E.R, so you know what the ER stands for. Okay, we're going to need a little line just to show that. Yeah, I'm not sure if you have to know if, this formula. We'll have to see in the past papers and that. The work program doesn't show the actual formula, but the text, the work program talks about it though. They talk about the real effective exchange rate. So you might or might not need it. It's better just to write it down just in case. Okay. I like the summary here that they've got. So I'm going to put a note here. Where we had the trade weighted exchange rate, I'm just going to add something here. Asterisk, a basket of goods is used to measure it. And then with this one, they said real purchasing power. The real purchasing power. Okay, and that's what you're looking at there. So the one is looking at a trade weighted exchange, meaning it's a percentage of, it's looking like a basket of goods. The real effective exchange rate is looking at more other factors, okay, between countries. So do we have high levels of unemployment? Do we have high levels of inflation? What else did they mention here? Are we competitive? Aren't we competitive? Is there significant trade between the country and the other? Are we price competitive? So there's a lot of factors. Those factors will determine what the real purchasing power is. Okay, and then the last rate. I think that's the last one, is it? Yes. Okay, so we had those three. We've got one more here. This needs to be in black. Okay, third one, floating exchange rates. Okay, so imagine floating in the pool. Okay, do you stay in one place or do you move around? You move around. So floating means rates that change, but based on some underlying rate. So for example, in South Africa, the rate that we have for lending and borrowing is dependent on the repo rate. Okay, you've probably heard of the repo rate. They normally announce every month or two, depending on when they host the meeting, and they tell you what happens to the lending rate, okay, the borrowing. So floating rate, just to summarize, they say here in the textbook, a floating exchange rate is one determined by market forces. Currencies are bought and sold on the foreign exchange market. This market does not exist in a single location and can be made up of many institutions across the world. Large values of currencies are bought and sold on a particular day. The price of the currency is determined by the relative strengths of the demand and the supply. Keywords there: floating exchange rates, dependent on the markets, bracket, supply and demand, determines the exchange rate for a currency. So if there's a lot of demand for a specific currency, let's say the US dollar becomes popular, even more popular now, would you expect the rate to increase or decrease? Increase. Okay, US dollars will be worth more than any of the other countries. Right, and therefore the exchange rate would probably be higher. We would have to pay more rands for dollars. Okay, new topic. A fixed exchange rate system. Still looking at exchange rates, but now we're looking at the system. So, fixed exchange rate system. If something is fixed, does that change? No, it doesn't.
Should I squeeze it up?
Yeah, you can. It's not a lot. Let me just see how much more you have to write about rates. Okay, 1, 2, 3, 4. That's it, 4. Okay, so 4 more points about the rates for exchange rates. Can you fit 4 more points? Well, they're not too long. This one is short, so do you have? Can you squeeze it in? Can you squeeze in one line somewhere?
Yeah.
Okay. A fixed exchange rate system. So if something is fixed, what does that mean? It doesn't change, exactly. So a constant exchange rate for a specific currency. Best example I can give you for this, in recent times, the Swiss franc was fixed against the euro. Okay, that was something that happened quite recent, and they obviously changed it. They lifted that fixed rate. Okay, so it became floating. Okay, remember you've got fixed, you've got floating. Floating means it can change. Fixed means, well, that's the rate. So if I look at an example, let's say South Africa had to fix the rate of rands against US dollars, and it doesn't change. So whether the US economy does well or doesn't do well, it's always going to be, let's say, 1 rand to 12 US dollars, and it stays at that rate. Do we have a fixed exchange rate system in this country? No, we don't, because the price of the dollar changes every single minute of the day. Okay, every day it changes. So we don't have this system. Some countries do have the system. Why do you think some countries would want to fix their rates?
To be more competitive.
Okay, to either be more or less competitive. You're either protecting your country or you're helping your country in terms of trade, yes. Okay, so just an asterisk here. Political reasons exist for fixing a rate. Okay, I'm trying to finish the rate stuff today. Okay, so I won't do the rest. As you said, it's a long chapter. Okay, so I'll stop after the rate stuff. Okay, so political reasons exist for fixing a rate.
Okay.
We don't know why certain countries fix rates. They have different reasons for doing it. The Swiss Switzerland, okay, had certain reasons for pegging the currency against the euro, right? It was mainly because of political issues, okay, inflows of money. Maybe just to add that as well, inflows and outflows of currency. Okay, right, we've got 2 more points. Managed floats. Next point. Managed float. A managed float in effect combines features of a floating rate exchange system with a fixed exchange rate system. Usually involves government intervention. Okay, best example, China does this. They let the price of the currency, the yuan, change, but they still manage it, so they intervene. Switzerland said it's pegged. This is it, this is it. But in terms of recent times, okay, so just a note here, a combination of the fixed exchange rate system with the floating one, floating rate system. Government intervention. Government intervention determines the current exchange rates. Okay. Anything else here? Okay, they mentioned that. They mentioned the supply and demand of these currencies. Okay. Then the last bit here is the factors underlying changes in foreign exchange rates. How many factors are there? Okay, they don't actually bullet it, which is a problem. Okay, we'll create our own bullets. Okay, so heading here, factors underlying changes in foreign exchange rates. Okay, there aren't that many. They've just given you one paragraph, so I'm just going to pull out the bullets. Right, so number 1, changes in demand and supply. Demand and supply changes. Okay, we just leave it demand and supply, just like that. Factors underlying changes in foreign exchange. Demand and supply is the first one. Okay, I'll try to keep it shorter so you can fit it in. Yeah, I see you're running out of space slightly. Okay. They talk about the demand side, where more people want to buy those currencies, the price of that currency will rise. Foreigners wanting to buy more, okay, that's fine, this is an explanation. They're doing interest rates, foreign firms have purchase rated value of the currency. Okay, speculation is the next one. There's the next bullet. Supply and demand. Speculation. Speculation means what? Do you have an idea? To speculate. Speculate means to guess. Okay, so you expect the rand to strengthen. You expect the dollar to strengthen. All right, you're speculating. Speculating is almost like trying to guess where the currency is going to go. Okay, it's very difficult to do that, but that's what some people tend to do. Okay, then they talk about the speculation. So a large portion of the population will expect a currency to rise or fall, etc., with the hope to making a profit. While an increase in demand for the currency will push up the price. Okay, that's speculation. Speculation. Okay, that's also speculation. Okay, governments. Alright, another reason, government policy. So here they said, a government might also decide to alter the exchange rate or influence the exchange rate in order to achieve a macroeconomic aim. Right, so government policy. So if the government wants to help grow the country, do they want a weaker or stronger currency?
Stronger.
No, they actually want a weaker currency.
Okay.
Because a weaker currency will make more countries buy from us.
Yeah, that makes sense.
Yeah. So let's say if South African products were cheaper, we'll get more exports. Does that make sense? Perfect. So I'm just going to use that as an example. Weaker currency equals more exports. Okay. And then the last bit here is just a depreciation or a devaluation in the exchange rate. So the last thing here, a depreciation or a devaluation of the exchange rates of the currency. Let's use that just to keep it simple. Currency. Okay, so you've probably heard of depreciation before, right? Depreciation means the value decreases over time. Okay? Devaluation is where you actually place less value on the currency. Okay? So here's the example. Has the South African rand depreciated in the last few years? Well, yes, okay, because of the political uncertainty and the corruption that was in the actual government. Okay, but would you say the rand has devalued? No. See, the rand is still rand, but it's just depreciated, meaning it's worth less. Okay, devaluation is Zimbabwe.
Yeah.
Okay, would you want Zimbabwean dollars?
No.
Definitely not, because it's worth almost nothing in terms of its value. Right, so when we talk about devaluation, we're placing less value on that country's currency versus what we can exchange it for. Does that make sense?
Makes sense.
Okay. Can you squeeze in those last 2 points there somewhere? Maybe at the bottom.
Okay.
Maybe just at the bottom, that little line across. Just those two definitions, they're quite important, and that's the end. Don't worry about Marshall. I didn't see Marshall here. Yeah, Marshall wasn't mentioned here. They just said appreciation and depreciation. They spoke about devaluation. Okay, so Marshall's not important in terms of the background, in terms of theory. Okay, remember, Marshall is an economist or a mathematician or statistician, someone that would have done research in the past. Okay, so I just want to end with that note about depreciation, devaluation, and what the difference is. Okay, just to read it, a decrease in the international price of a currency caused by market factors. See, that's depreciation. So depreciation, brackets, decrease in price. Simple. Devaluation, a decision by the government to lower the international price of the currency. See, lower value. Right, so we're actually going to be making our currency worth less, okay, rather than just decreasing the price. It's quite an abstract concept. The best way I could describe it is South African rand, not as strong as before. That's depreciation. That's not devaluation.
Makes sense.
Okay. The opposite is appreciation and revaluation. That's all. Okay, that's the complete opposites.